This video will walk you through the solution to exercise 15-21, which focuses on defined benefit plans under ASPE. This question is a duplicate of exercise 15-10, where the company reported under IFRS. Here's the background data for our problem, which is exactly the same as in exercise 15-10. The following information regarding Mirosec Inc.'s defined benefit pension plan is as follows. The beginning balance of the DBO on January 1st, 2027 is $4.4 million. The opening balance of the plan assets on January 1st is $4,550,000. The current service costs for 2027 are $565,000. The interest rate on high-quality corporate bonds is 8%. The actual return on the plan assets in 2027 is $312,000. There's a remeasurement loss due to changes in actuarial assumptions on the DBO of $176,000. Contributions made by the company to the plan in the year were $422,000, and payments made by the plan to retirees in 2027 was $166,000. And in this question, the company reports under ASPE. There are 3 requirements for this problem, so let's begin with requirement A, which asks us to complete the pension worksheet for 2027. So here's what the pension worksheet would look like. We've got 2 columns for the DBO and plan assets that we track for the pension plan, which is managed by the external trustee. And then we have 3 accounts to track for the company's accounting records: the net defined benefit balance, the cash, and the annual pension expense. Notice in this question, there's no column for other comprehensive income because that appears only under IFRS. So let's start by putting the opening balances into our table. The opening balance of the DBO is $4.4 million credit. The opening balance of the plan assets is $4,550,000 debit. As a result, on the company's books, it's carrying a net defined benefit asset of $150,000. That's the difference between the $4,400,000 DBO balance and the $4,550,000 plan asset balance. The service costs are $565,000. That's going to increase the DBO and it's going to kick off our pension expense. So we have a $565,000 credit to the DBO and a $565,000 debit to the pension expense. Next, we have the interest on the DBO, which is calculated based on the beginning balance of $4.4 million multiplied by the 8% interest rate on high quality bonds. That's $352,000. It's a credit because it increases the obligation of the DBO on the trustee's books and is added to the pension expense on the company's records. So there's a $352,000 debit there. Then we'll calculate the interest on the beginning balance of the plan assets. We'll take this $4,550,000 beginning balance in the plan assets multiplied by the 8% interest rate. That's $364,000. It's a debit because it increases the value of the plan assets as the interest is reinvested into the plan. On the company's books, it offsets the interest on the DBO. So it reduces the pension expense by $364,000, and that's why it's a credit. Then we have the company's contributions into the plan, which increase the plan assets by $422,000 and decrease cash by $422,000, which is why it's a credit. Then the plan paid benefits to retirees, so that reduces both the DBO and the plan assets by $166,000. It's a debit to the DBO and a credit to the plan assets. Next, we can deal with any remeasurement gain or loss on the plan assets. Once we've calculated the estimated interest of $364,000, we compare that to the actual return on the plan of $312,000. In this case, the plan underperformed, resulting in a remeasurement loss on the plan assets. So we have to reduce the plan assets by $52,000, which is a credit, and add that $52,000 to the pension expense to increase it with a debit. Then we're also told there was a remeasurement loss due to changes in actuarial assumptions on the DBO in the amount of $176,000. This can happen quite often because the actuaries do their best to estimate what the obligation should be based on mortality rates, retirement rates, etc. So in this case, the company has to increase the obligation on the DBO by that $176,000 remeasurement loss. That then also gets added to the pension expense with the debit. Now we have all the information we need to determine what the journal entry is going to be for this. When we add up all of the items in the pension expense column, that works out to a total of $781,000. So that's going to be a debit to the pension expense. The cash contributions made to the plan were $422,000, so it'll be credited to cash. The difference between those two items is the amount that will be adjusted to the net defined benefit account. In this case, that's going to be a credit of $359,000. And when we include that in the net defined benefit balance column on our table, we can now determine the closing balances to be $5,327,000 credit for the DBO, $5,118,000 debit for the plan assets, and $209,000 credit to the net defined benefit balance. As you can see here, it changes from a $150,000 debit balance, which was an asset at the beginning of the year, to a $209,000 credit balance at the end of the year. A net defined benefit balance should add vertically in the column and horizontally by taking the difference between the DBO and the plan assets. So the $5,327,000 credit balance on the DBO minus the $5,118,000 debit balance in the plan assets is a net credit of $209,000. Requirement B asks us to prepare the journal entry to report the pension transactions during the year. We actually already did this, but here it is presented a little bit nicer. Again, debit pension expense, $781,000, credit net defined benefit liability, $359,000, and credit cash, $422,000. Requirement C asks us to prepare the balance sheet excerpt showing how the pension amounts would be disclosed at December 31st, 2027. That's very simple. From the table, the net defined benefit balance is $209,000. It's a credit, therefore it's a liability, and it will be classified as a non-current liability because the pension plan will be in place for many years to come. And that's it. We've solved this problem.